And this weaker-than-expected economic data isn't going unnoticed by the Federal Reserve, which, as Steve Liesman reports, is becoming more divided over the timing of a rate hike.
Chances of a Fed rate hike this year seem to be slipping away after the government reported lower-than-expected retail sales in September. There was weakness in gasoline station, grocery store, and electronic sales. That was offset somewhat by strong car, clothing, and furniture sales, and the overall numbers eked out a small gain. But there was a downward revision to overall spending in August, adding to the sense of an economy that has weakened, if not stalled, in the third quarter. The data supported comments from two Fed officials who have said in recent days they were more worried about risks to the economy and did not support rate hikes this year.
Right now, my expectation is, given where I think the economy would go, I wouldn't expect it would be appropriate to raise rates. But I want to hasten to add that that is an outlook that changes based on developments in the economy and our being forward-looking about it.
Fed Governor Tarullo's comments, along with those of Governor Lael Brainerd, have Wall Street thinking the first rate hike in 9 years looks more like a story for 2016 than 2015.
The market's pricing in a fairly low probability of a hike in October. Whatever level that probability is at is too high. At this point, you have to assume it's a 0 for October. The probability of a hike in December is currently being priced in around 1/3. That's probably too high as well at this point.
Comments from the two Fed governors raised another issue: whether Fed Chair Janet Yellen controls her committee. Yellen has said she expects rates to rise this year. It's rare for governors appointed by the president and confirmed by the Senate and with offices right next to Yellen to disagree with the chair, let alone dissent. The 12 district bank presidents, they're often more outspoken than the Washington governors. That has some Fed observers wondering if there's been an internal revolt at the Fed among the doves closest to Yellen. It's certainly led to a confused message.
If the Fed's message is garbled, it's not necessarily because the Fed is doing something wrong, but it's more about the fact that the economy and the data continues to sort of interfere with what the Fed expects it's going to do.
Come December, if the data is clear about the direction of the economy, then Fed officials may be clear and united about the direction of rates. For Nightly Business Report, I'm Steve Liesman.